Okay, so this session is being recorded. I want to welcome Paul Petruska with Greensfelder to present this today. He is an experienced trial attorney, estate planner, and small business advisor who focuses on solving each client's unique problems. He has a diverse work history, and he began as an associate for a medium-sized insurance defense firm. He became a partner in a boutique litigation firm and was the chief trial attorney for large commercial insurance major case units. Paul works closely with clients to help them understand, evaluate, and address areas of risk to avoid potential litigation. He is well-versed in liability analysis, data analysis, and strategic planning, helping him to accurately assess the best course of action in a given dispute. As new needs has arisen, Paul has looked to address them. During the pandemic, he has drafted several policies specific to COVID-19 and advised on the Paycheck Protection Program, which we're going to talk about today, along with the shuttered venues grants and the landlord lease program that is out there too. So Paul, I want to thank you for joining us today. And please, if you have any questions for Paul, feel free to drop them in the chat box and we'll be monitoring that. But thank you for joining us. And Paul, the floor is yours.
Well, thank you very much. As Wendy mentioned, my name is Paul Petruska. I am happy to be here today. I'm representing the Greensfelder Hemker Gale Southern Illinois office. I'm very proud to be representing them, and I'm going to take a minute here just to explain why that is before we get into the fun aspects of the relief, because it does tie in. Believe it or not, in July and through September, Greensfelder and I were talking about me joining the firm. And you may be asking, wait, you're kidding me. A law firm is looking to hire someone new in the middle of a national pandemic, and some lawyer is dumb enough to look for a new job in the middle of a national pandemic. And that actually was the situation. And the reason was that I had some experience in dealing with the PPP beforehand, the Paycheck Protection Program. Greensfelder saw a need. They have plenty of lawyers that do this, but they saw an opportunity with another lawyer who could offer some assistance in this. And part of the reason I'm giving this presentation here today is because I watched as the first round of the payroll protection program went off, and it did not go particularly well. $350 billion disappeared in 2 weeks, with people like Harvard, Yale, and Ruth Chris getting millions of dollars, while a lot of people got set on the sideline and didn't even get a chance to apply yet. I watched as the second round, or they refunded, they added more money to the first relief, and still there were people that didn't fully understand how it worked. When this second round came out, which is what we're going to talk about today, the new relief bill, there's a lot of provisions in there which are new and different. And my goal is to look at the fundamental basis of what we are as lawyers. We're here to solve problems, and we're here to help. And that's the reason I'm doing this here today. I'm not going to have a practice in PPP for the next 20 years. This is a short-term thing, but I'm hoping that all of us can survive until we can get to the point where the vaccines are working. And I think we all know there's going to be an incredible uptick in our economy, because who isn't wanting to go on vacation? Who isn't wanting to go to dinner almost every night? Who isn't wanting to have large group events again? We know it's coming. We just got to find a way to get there. And that's part of what this is about. So let's look at the first part, the summary. In December of 2020, Congress finally got something put together, and they agreed on essentially $900 billion in relief. Part of that was $284 billion allocated to the Paycheck Protection Program, which many of you may have had experience with before. Another $15 billion was put in for what they call the shuttered venue operators, and I'll be talking about that later as we get there. But that was absolutely necessary. I will mention that a lot of restaurants were hoping for $100 billion in something called the Restaurant Relief Act, or the Restaurants Act, and it didn't come through. But the $284 billion that was allocated to the Paycheck Protection Program does have some specific relief just for restaurants that only restaurants will be able to take advantage of. And there actually is more money available to restaurants in this round than other industries, including hotels, by the way, are also included in that, and we'll talk about that. There's also 25 billion in rent relief, which there kind of was before, but there was a huge problem in the rent relief. The rent relief required the renters to go get the relief. And to be honest, if renters were not going to be evicted, in many situations, renters weren't even going to apply. The landlords were stuck. They couldn't evict. They couldn't force someone to apply for money. And I have several landlord clients already that are attempting to, are hoping to be able to actually apply for their renters and get the money themselves. And believe it or not, the government did it right this time and they allowed that. That's one of the things we'll talk about today. First preliminary assumption that I'm giving this presentation with the belief that you've already gotten, your business or your clients have already gotten the first round of payroll protection program relief. The reason I'm saying that is because there's different qualifications. This is called the second draw, or I'm calling it the second round. The qualifications. Someone just joined. If you could mute, that would be helpful. So the second round has different qualifications than if you had not gotten a loan. If you have not gotten the first PPP loan, I guess you can email me later and we can talk about, but it's really the same qualifications for the first round. I'm not going to talk about that today because I'm assuming everyone already got a PPP loan, and the other requirement is it must have been fully spent already and forgiven. If you have some left, it's going to change the analysis here. I can't cover every fact of what it takes to qualify because, as you'll see in this presentation, I get pretty detailed on some of this, and that still doesn't cover everything. But I will be able to cover the majority of the issues that you may have in qualifying for the second draw of the Paycheck Protection Program. First, and I'm including this because I don't know everyone that's going to be on this, and it's really overlooked a lot. Part of the payroll protection program is that you must qualify as a small business. However, there's also a code of federal regulation involved, which is 13 CFR 120.110. And that actually says which businesses are eligible and are not eligible for, actually, this one says which businesses are not eligible for small business loans generally. And there are a lot of them, which is why I wanted to talk about it today. I highlighted two of them in here because this second draw of the PPP actually has specific language saying that the ones I highlighted are included, okay? But there are a ton of businesses that would not be eligible, and they're ones that you would think of that would not be eligible. I'm not going to cover all of these, just read this to you, but I put it in here because in case anybody wants to see it, we can make this available for everyone else, but I did want to talk about a few. There is a provision in here about passive businesses owned by developers and landlords that do not actively use or occupy the assets acquired or improved with loan proceeds. I'm raising that because that is an example of part of the problem with the Paycheck Protection Program. The first time it was out there, landlords didn't qualify because of this provision. They changed some of the rules slightly to allow some landlords to be eligible. In this round, the second draw for the Paycheck Protection Program, they allow co-ops to be eligible. But in general, a landlord which owns businesses and does not use that, owns land and or buildings that does not use the land and buildings is not going to be eligible for a PPP loan. That's.
I literally only wore it fucking one day.
Whoops, hold on, Steph. Someone just came on without a mute. Please mute. Okay.
Sorry.
No problem whatsoever. We're all adults here. We can handle some language. So this is part of it. And I include this second one because I don't know why, but I find this interesting, the way they list this. The second exception on here are of businesses that do not qualify are businesses that present live performances of a prurient sexual nature or derive directly or indirectly more than de minimis gross revenue to the sale of products or services or the presentation of any depictions or displays of a prurient sexual nature. Only the government could come up with words like that to explain what qualifies and what doesn't. I'm not sure if any of those are on this here today, but if you have a business that involves prurient sexual nature, you will not be able to get the Paycheck Protection Program. Okay, so the new law does allow churches and religious groups to be eligible. They were somewhat excluded the first time around. As I mentioned, housing cooperatives are eligible and they're specifically defined. And then there's certain types of 501c3s which are eligible, which may not have been eligible the first time around. If you are a 501c3 or a 501c19, please realize that you are expressly allowed to get the second draw of the PPP because it's in the language of the law. Additional requirements this time around slightly different. You must have 300 or less employees. Last time it was 500. You must be in operation on February 15th, 2020. Why? Well, they decided to have a date and they picked this particular date. You must have been in operation on that date. If you were not, you're not eligible. There are no publicly traded companies. That was put in specifically to avoid a lot of the issues they had in the first round. As with the first round, if you're a sole proprietor or an independent contractor, you are eligible. One of the things I don't have in this presentation, but I should at least mention, when you're a sole proprietor or an independent contractor and you don't have other employees, there's not a lot of money you're going to be able to get. And we'll talk about why. But I generally have helped several of those already. And we're talking sometime between $5,000 and $10,000 that you are able to get. And there's a limit on it. And there's a reason why. We'll talk about it. But this is the most important part. In order to qualify, and I suspect most businesses that are here today will be able to meet this, 1/4 of 2020 must have at least a 25% reduction in gross receipts or revenue compared to the same quarter in 2019. If you are a restaurant, you clearly meet this because you were shut down for at least most of the second quarter of 2020. And even if you had one of the worst quarters of your life in 2019, I suspect 2020 is still much worse. So most people will be able to meet this. All you need is one. So think about it, 1/4 of 2020 that has a reduction in gross receipts of at least 25%. It can go up to 90%. But as long as you have that, you will be able to qualify this time around for a second draw from the PPP. Unfortunately, there are some businesses which are still having problems that can't meet that. And there's reasons for it. I actually have a client that has that issue. Can't meet this requirement, can't get the PPP. Unfortunately, that's very specific. Maximum amount of loan. This is where it gets involved with your number of employees. There's a basic calculation for everyone except for a code 72. And I'll just show you that right now. Code 72 is this book that I'm showing you the first screen of, the North American Industry Classification System. Explains what a code, every industry is put into a code. The code 72 is this one. It's basically hotels and food services and bars. If you are a code 72, you get a different multiplier. You get more money, essentially. So let's talk about if you're not code 72. What you have to do is you have to look at all of your employees and figure out what your total cost of your employee payroll is for all of your employees. And then you get a monthly cost. And that monthly cost, so if you have one employee, it's one employee's salary divided by 12. And that's your average monthly cost. If you have 20 employees, you put all of that together, divide that by 12, and now you have a monthly payroll cost. And you get to multiply that by 2.5 That would be the maximum amount of money that you can get in this second draw of the Paycheck Protection Program. If you are a restaurant or a hotel or otherwise, you get to use that same formula of average monthly payroll cost, and you get to multiply it by 3.5. And that turns out to be somewhat important because there are things that restaurants and hotels can use this money for that other people cannot. So that extra money actually helps. Now, anyone getting a Paycheck Protection Program loan prefers that it not be a loan. They hope that they can actually get it forgiven. And we will talk about that in a little bit. But the 3.5 multiplier gives you a little more room to spend money on things beyond just employee payroll to hopefully help your restaurant and or your hotel. And you can still get the full amount forgiven based on a formula, which we will see. So I just went through this. Average monthly payroll costs. This is obviously the most important factor in determining how much you can get in the payroll protection program. Anyone on this call or on this presentation they don't need me specifically. They don't need a lawyer to actually get a payroll protection program loan. You can go to a bank and you can get this without a lawyer. However, some of these things are rather carefully worded. And I think by attending this today, I hopefully will be able to help you understand how you calculate your average monthly payroll cost. This is the question I get the most from the clients I work with, that they don't even get how do I determine this amount that I then get to multiply. So payroll cost is all employee salary, except for once you get to 100,000, the rest of that money cannot be included. That does not mean that someone with 150 is excluded entirely from your costs. It just means that the 50,000 above 100 is not included. So if you have 4 employees and 3 of them are making 36,000 a year and the owner is making 150,000 a year, you get to include the 3 that are making 36 and 100,000 of the 150 in your average monthly payroll cost. If you're a restaurant or even retail or sales and there are commissions and tips, those are included. It's not just the hourly wage. The tips and commissions are included. Vacation pay, leave pay, group health and retirement pay, state and local taxes. Those are all included in the monthly cost. And that's important because it makes it easy if you have a salary. You don't have to take things out. You get to include basically the gross amount the employee is getting. And you don't have to go back and say, well, this isn't included, so I got to subtract that. Excluded from payroll costs is, like I said, any tip or commission above $100,000, any payments to independent contractors. For the shuttered venue people that we will talk about at the end of this, they actually get to include payments to independent contractors. People getting payroll protection program do not. Your people working for you must be an employee. They cannot be a 1099. They must be a W-2. The other thing that is excluded is any payments you make to people who are principal residences outside the U.S. I'm hoping that's not an issue here in lovely Belleville. I'm giving you 2 examples just to show you how easy or hard this can be, average monthly payroll cost. So let's assume you're a small C Corp business with 10 employees, including the owner, who are salaried. 9 have a salary of $36,000, which is just $3,000 a month. And the owner has a salary of $72,000 per month, which is $6,000 per month. Your average monthly payroll cost, and by the way, you have some benefits to your employees and other things. You don't have to worry about all of that because those are all allowed to be included. Therefore, it's the 3,000 times 9 is 3,000 a month times 9 plus the 6,000 for the one owner. And your average monthly payroll cost is $33,000, and you get to multiply that by 2.5. It's not particularly hard, but it can get complicated. Let's assume you're an LLC. When you pass through your profit to yourself, now you have a somewhat different analysis here. Also, if you have 10 employees and they're all hourly, we have a totally different analysis, and it's not quite as easy to figure out what your average monthly payroll costs, especially if you have 3 managers who are getting health benefits, and then the other 7 are getting commissions and or tips. It's much more complicated. So I don't like to get into tax returns very much, but I figured I would at least raise this so that you can at least understand how you would try to figure out what is my average monthly payroll cost. So that same owner of the LLC, the owner himself, herself, would look at line 31 of Schedule C of 1040. And that line is basically the profit for the LLC for that year. And that would be the owner's pay, assuming the owner did not pay himself, herself a salary. That's the yearly pay divided by 12. You get the average monthly pay for the owner. For the other employees, you'd have to look at the 4 quarterly Form 941S's, column 1, line 5C, which is where it talks about the wages paid to the employees, including their tips. And so you could look at that, and that would give you an idea as to each quarter, get it for the year. Then you have all of your employee wages, which would go into the wages and tips, which would go into the average monthly payroll cost. Healthcare costs are on line 14 of Schedule C of Form 1040. And that would be something else that you would be able to include with the 3 managers who had healthcare costs, who were paid hourly. The reason I put this in here is just to show you it's not as easy as it may appear to figure out average monthly payroll costs, and you don't want to short yourself. This is the first number that you then get to multiply. So this is where an accountant or banker or attorney may be able to help you if you need it in applying for this. So we have once we get all those numbers, there's then some division divided by 12 or 9 or whatever it is in order to figure out your average monthly payroll costs. I know that wasn't crystal clear, but that's not my intent. I'm just trying to make sure you understand that this can be a little more complicated than just looking at how much did I pay someone that month.
Real quick.
Yes.
It's Wendy. There's a question, and I think you addressed it, but I just want to make sure. There's a question in the chat box. Is the amount that you can claim including an employer's FICA share?
No, the employer's FICA share is not included. And that is something that is in advice from the SBA. You're not going to find it in the law, but no, the employer's FICA share is not included.
Okay, thank you, Paul.
Okay. This form here is the current application form for the second draw of the PPP. I know you can't see it, but I'm going to show you a better version of this in just the next slide. But I'm showing you this form. This is not the form that your bank may use, but it's going to be really close to this. This is the 1-page form, and the second draw said we're going to require the lenders to have a 1-page form if you're looking for less than $150,000. And so this is a general idea of what you might have to know to be able to get your PPP loan. I thought this would be helpful for you to see. You can find this on the SBA site, but I have it also. And I'm going to briefly show you what you have to know and what you have to be able to put down to get your loan. So this is the section in the form, and we already talked about the first column on here, your average monthly payroll cost. You fill that in once you figure it out. This one happens to say only by 2.5. Again, this is an SBA form. It's a general form. If you're a restaurant, there's a different box for 3.5. And the forms that I've already seen for the second draw from most lenders do have a second box allowing you to multiply it by 3.5 if you're a hotel or restaurant. So this form doesn't have it, but that's where it is. So this is one of the things that you would have to disclose in order to figure how much you can get. It's not particularly hard. Above this was information about your business. That shouldn't be particularly hard. And then it asks you to say, what's the purpose of the loan? What are you using it for? And you don't really have to check all of it. It's helpful to you if you're planning on getting this forgiven to say what you're going to use it for, but you could literally just mark payroll costs and still get your loan. But they want to make sure you're getting the loan for a legitimate reason. These are the questions on that form that you have to answer as a business. And again, most of you hopefully are going to qualify under this. This should not be awful questions to have to answer. First one, have you been disbarred from the SBA? Second one, are you owned or controlled by someone that is currently delinquent or is defaulted in the last 7 years on a loan? You can see other things. Did the applicant receive an SBA economic injury disaster loan between January 31, 2020 and April 3, 2020? If yes, you have to provide that information separately. As I said to you earlier in this, if you already received one Paycheck Protection Program loan, that's what we're talking about. You can still apply for this. Even if you didn't get the PPP the first time, but you got the economic injury, which I will discuss. If you got that loan, you can still apply. You just have to give different information. The key thing here is they really do want those. The economic injury disaster loan will not have been paid off because it's actually paid off over 30 years. And so there's some refinancing issues and things. That's the reason they make you disclose it. There's issues about whether you've been incarcerated, when you've committed a felony, whether your principal place of business is in the United States, whether you're a franchise. These are the questions you have to answer. So going back, the section up here is just what your business is. I showed you this box, and then I just showed you these questions. That's literally the application form in a general sense for the PPP. So hopefully not impossible or hard to file. What's the allowable uses? And this is very important because if you get this loan, you want it forgiven. That's the whole goal. It's free money if you can get it forgiven. Again, you do not have to pay this loan back if you use it properly. That's another situation where an accountant or a lawyer or even your lender can be extremely helpful to you to make sure you account for the use properly. Because I would hate for someone to get this loan, this PPP loan, thinking they don't have to pay it back and then make a mistake and then they do. So let's talk a little bit about what you can use this money for. In round one, you had only specific uses and I listed them here. These are the only things you were allowed to use the PPP for: payroll cost, continuation of benefits. So the idea was, hey, business, we'll give you money if you hire back your employees that you laid off. And this is a good time, I guess, for me to bring up some stories of the first time around so that you understand how this in real life works. A lot of my clients that got round one PPP loans, when they applied for them, they didn't have employees. Their businesses were closed. The employees were not working. They got this loan with the idea of rehiring their employees. And even if they weren't going to work, they were going to get paid. And then the business then could also pay off their rent and their mortgage and other things to keep themselves in business. Hopefully people wouldn't be getting unemployment. It was a good idea. What happened is by the time they got the money from the first PPP, all those employees were back. Well, guess what? Now they had money to pay them and they had extra money in the background for other things to do. So this loan turned out to be highly useful the first time around. The same thing is true now. Okay, this is an accounting issue. You must be honest and you must swear to all of this, but let's talk about this. If you get money to pay your employees, but your employees are actually working, you account for this money. You say, I'm spending this money on keeping them employed, and you account for it that way. But it doesn't mean that it has to be exclusive for that. Okay. Here's the key for the restaurants and hotels and others that are on here. There are new uses for the funds that you can use for your restaurant and or hotel. And other, by the way, other businesses can use these. And those are, I hate the way the government defines things because it's always hard. But those three new uses are covered operation expenditures, covered supplier costs, and covered worker protection expenditures. What in the heck is that? This is actually mostly a quote from the law itself. A covered operation expenditure is defined as a payment for any business, software, or cloud computing service that facilitates business operations, product or service delivery, the processing, payment, or tracking of payroll expenses, human resources, sales and billing functions, or accounting and tracking of supplies, inventory, records, and expenses. You may say, hey, my business is almost dying. Why do I care about buying new software? Well, the whole thing here is calculating this average payroll cost sometimes can be quite hard. If you can upgrade your software in the future, this may be easier if something like this occurs again. Good news, once the government has a program, they rarely get rid of a program. That means this PPP program may come around again. So you might want to spend the money on software. I doubt it. I suspect most of you aren't going to want to do it, but be aware you can. I'm going to skip this because I basically just talked about it. The other one which people will be interested in is a new allowable use is the covered supplier cost is defined as an expenditure made by an entity to a supplier of goods for the supply of goods that are essential to the business operation or that is made pursuant to a contract order or purchase order of interest. This specifically applies to perishable goods. So what are we talking about? Again, if you are a restaurant and you bought a bunch of perishable goods in the past and you lost all of that, in theory, you can account for some of this money for paying that off, and it's still an allowable use of the funds. As of now, it would appear that this provision would allow to cover such losses that occurred during the cover period, and more importantly, before the cover period. Again, that's in the law. It says that before the cover period. What's the cover period? Cover period is when you get this loan, you must spend it. You must spend it in a time period. That time period must be at least 8 weeks and must no longer than 24 weeks. There are reasons why you may want to extend it if you got more money than you may need. And that's the reason you can extend it for 24 weeks. However, that's your covered period. So if you have losses right now during your covered period, in theory, you can use this money to pay for those covered losses, such as perishable goods or other things that your business was purchasing that that somehow you got destroyed in this process. You can use this money for that. But here's the key one. A covered worker protection expenditure is any expense to the business related to compliance with requirements established by a health group. That health group is almost any of them, including your local health group. As an example, in St. Louis County, restaurants were closed. And while in St. Charles and Jefferson and other places around there, they weren't closed. One of the reasons they were closed is because they didn't have proper ventilation or other things like that. One of the things that you can do now with this money is, depending if you have enough employees where you can get enough money for this, you can actually install a drive-through window in your restaurant, and that is an allowable use. You can change your ventilation system. Let's just say your HVAC was old. You can get a new HVAC system, and I will let you all know that I've been working with a lot of experts on the health and safety issues that arise from this. And my mechanical engineering experts will tell you that if you change your air system inside your restaurant or your bar or your business, you're making it safer. Not perfectly safe, but safer. 6 air changes per hour is something most of us do not have. But if you upgraded your system, in theory, you would have an argument to say that I should not be closed down if this ever occurs again, because your restaurant is much safer than other restaurants or bars or businesses. The more air changes you have per hour, the more you can deal with the virus. Another interesting issue that I've seen very few, but some restaurants have done and other businesses have done, is ultraviolet light in the ceiling. So if you have a ceiling above 10 feet high, there are companies now that will install ultraviolet light in the top part of your ceiling, so it doesn't cause damage to your patrons below that 10 feet level. And as the air circulates in the restaurant, any virus that gets hit by the ultraviolet light at the top gets killed. Now, I don't think anyone really cares about that right now. We just want to get businesses back in. But assuming you had enough money to try to change your restaurant for the better, or even if your HVAC unit is just really old and you want to replace it, that's an allowable use this time around. An expansion of additional indoor-outdoor combined business space, an on-site or off-site health screening capability, a physical barrier, or any additional miscellaneous items such as personal protective equipment. These are all covered now. I can give you examples of plenty of restaurants that I have been to that have spent an inordinate amount of money to ensure people could sit outside and enjoy themselves. Heavy pipes, heavy heating. Anyone that's tried to put heaters in understands that propane's expensive. These are all things that can be used, this money can be used for, and still make it forgivable. Even if it isn't fully forgivable, which we'll talk about, this may be a good use of some funds for those of you that are trying to prepare for the future in case something like this would ever happen again. By the way, the drive-through window is one example of an allowable use, which only restaurants are going to use. That's the reason I said that restaurants do have some advantages here. So forgiveness. There's a new formula to determine how much of the loan is forgivable. Last time it was different. You had to basically spend almost all of it on payroll. In a very basic sense, if you spend 60% of this money on payroll, the whole thing's forgiven. You may say, I can't believe that. Well, here's the form. And it has a section under the bottom there. It says potential forgiveness amount, line 12, 13, and 14. And one of those is payroll costs, 60% requirement. It doesn't seem obvious, but if you spend 60% of your loan on payroll cost, the entire amount of the loan can be forgiven if you use the rest on the allowable use. So that's the reason I'm saying restaurants and hotels do have an advantage here. And there are some things you can do if you think ahead to make it better and possibly protect yourself in the future. I didn't really put a lot into this presentation on the EIDL, the Economic Injury Disaster Loan, but please be aware it is out there. I told you I have a client that could not qualify for the PPP, and then but that client still needs money. Economic Injury Disaster Loan is another option for you, okay? This is a totally separate program. If you want to think of it in its most simplistic terms, the Economic Injury Disaster Loan is that same program that people that survive businesses that survive hurricanes, how do they get their profit back? This is what it is, this program. And they allowed it to be used for this pandemic, okay? So it's another option. To avoid confusion, anytime anyone goes looking at the Economic Injury Disaster Loan, they end up calling me and saying, wait a minute, what's this grant? And why is it gone? And I can't get this, and it's only $10,000. So I want to make this clear. The EIDL, Economic Injury Disaster Loan, has really three parts to it. One was the initial $10,000 grant. That was free money. It was a grant to anyone that wanted it. One of the big questions I had from people was, if I only want $10,000, should I get a PPP or should I get an Economic Injury Disaster Loan? And that's something we addressed before. It's no longer an issue. That grant money is gone, okay? The $10,000 advance is gone. There is something new now called a targeted EIDL advance. That's different than the first advance, and there is new money for that. And you might be able to qualify for that, but I'm not really getting into that right now because I'm just talking about the EIDL. So the loan portion is the third portion. You have the advance, which is gone, the targeted advance, which is new and refunded. It's got more money. Again, that's limited at 10,000. And then you have the loan. Okay, the loan is what I'm talking about. It has great terms. 30 years you get to repay back this loan. 3.75% fixed, and you get 1 year deferment for this loan. So if you can't qualify for the PPP, this might be another option for you to get some money to survive until we can get to the point where the economy starts growing again. How much can you get? Unfortunately, I can't answer that because it's the form itself, and I give you the link here for the form. It's on the internet, and you literally just fill it in as you're on it, and then someone calls you and tells you what you qualify for. There's not a set amount like the PPP, but you can get up to $2 million, and you have basically you have to show what your economic injury is. You have to produce a lot of documents to show what that economic injury is, but you can get a loan, and the terms are great. In general, they're great. So that's yes.
We have a question real quick. Do you know if there is any discussion or any possibility that the EIDL loan itself will be waived in part or in whole?
So the advance that we talked about previously was the waiver, meaning the first 10,000 of the loan the first time was waived, and this targeted advance is also waived. So it's a grant essentially. It's part of you apply for the loan, and then the first 10,000 of it now can also be waived. The rest of it, no. It may be able to be refinanced. There may be ways to address that in a future time, but as of right now, if you get an EIDL loan, you must consider it a loan until that changes.
Thank you.
So that's how that plays. The target advance, just so you know, it's targeted to economically depressed areas, and it's very specific, and I didn't want to waste a lot of time today on that specific issue as to how much, because again, it's a $10,000 small part of this. It's also disadvantaged groups and things like that. It's very specific. Okay, so now we've left the PPP. I've discussed it as best I can. I'll take questions at the end of this, more on the PPP. I briefly discussed the EIDL. I gave you the link, which means literally if you click on that link and you say apply here, you can start doing it today, applying for the EIDL if you wanted to. Now we're going to talk about the shuttered venue operator grant. If anyone on here is a live performance place or a playhouse or a movie theater, this is for you. Your industry group advocated for this. And I suspect that your industry group, if you're a member of it, has already told you how this works. But I wanted to make sure I covered it because it is a very specific thing for shuttered venue operators, and it is much more advantageous than a PPP. First, it's $15 billion set aside. Of that 15, $2 billion of it is set aside for venues with fewer than 50 full-time employees. It applies to theaters, museums, zoos, live performance venues that saw a 25% reduction in revenue. If there is a single live venue place that has not had a 25% reduction venue, I want to know who it is, because most of them have been shut down. It's been almost impossible to have live events. So I suspect every one of the shuttered venues will be able to qualify. The eligible applicants will qualify for a grant equal to 45% of their gross earned revenue. 45% of their gross earned revenue with a $10 million cap. That's a heck of a lot more money than the PPP. And it's a grant, not a loan. Applicants must have been in operation on February 29th, 2020, much like before I told you they have to have a date for this. They picked February 29th. Applicants must not have received a second draw of the PPP loan, which is what I talked about earlier. If you got that, you can't get this. I'm telling you today, get this if you can get it. If this is available to you, you want this over the second draw. So who is eligible? It's a live venue operator or a promoter. It's a theatrical producer, not just the playhouse, but the producers of it. It's a live performing arts operators, the houses, museums, zoos, and aquariums. I say certain because, my God, the government went into very specific detail of defining what these things are. And unfortunately, I'd have to read it to you if you wanted to know whether you qualify. But it's generally speaking, if you are a movie theater and you're not, well, we'll get to that in a little bit. But if you're a live performance venue, you're pretty much going to qualify. It's not as hard as it may appear. If you're a talent representative, you're eligible. Motion picture theater operators. Each business entity owned by an eligible entity that also meets these requirements is available. So let's say you have 3 of these. You have 3 different businesses and you have 3 of these. Each one is eligible if it qualifies. There are certain things that will automatically disqualify you. If you're an SVO, a shuttered venue operator, that's owned by an entity that has securities listed on a national security exchange. I don't quite know why they didn't just say publicly traded. I'm sure there are some accountants that can explain this better than me. I just know that's the wording they used, and then they defined it. So if you are owned by an entity that has securities listed on a national security exchange, you cannot apply. And this is good. It helps the smaller venues be able to apply for this. If an SVO has the 10% of gross revenue from federal funding in 2019, you're not qualified. That's unfortunate, but that's the rule. There are some additional things that will disqualify you. If you own a venue in more than one country, you're out. I don't believe anyone on this presentation today is going to have that issue. Maybe, but I don't believe so. If you own a venue in more than 10 states, you will not qualify as an SVO. If you employed more than 500 employees as of February 29, 2020, you will not qualify. Let me clear that up. You must have, if you have 2 of those factors, you don't qualify. So of those 3, if you have 2 of them, you don't qualify. If you only have 1, you still qualify. If the venue presents live performance, again, I put this in just because I love the wording. If the venue presents live performance of a prurient sexual nature. Shuttered venue operator grant. If the SVO was in operation on January 1, 2019, it may apply for an amount equal to 45% of the gross earned revenue for 2019. This is easy. You get to look at your tax return and say, what was my gross earned revenue? And you get 45% of that. If the SVO was not in operation on that date, then the formula is slightly different. It just means you got to look at your average monthly gross earned revenue for each full month of operation in 2019. Multiply it by 6, but no higher than 10 million. There is a unique timing for this application because some of these SVOs are so devastated that they have set this up slightly different. First and foremost, this is not available yet. Okay, this grant is not out yet, although it looks like it's coming soon. Once it does open and you can apply for it, during the first 14 days, only certain people will get the grants. Those SVOs are the ones that had basically a 90% loss in earned revenue. So you must have not more than 10% of the revenue from 2019. So 90% loss, you'll get grants, at least a 90% loss. You will get grants in the first 14 days. The next 14 days, so 15 through 28, those that had losses of 70% will be available for their grants. And the reason they're doing this, again, is we got 15 billion. Sounds like a lot, may not be enough. So if you have 70% loss, you will get your money, your grant, within the next 14 days after the first 14 days. After that, assuming there's money left, then any SVO that qualifies will be able to get their grant after the first 28 days. That doesn't mean you don't apply. You apply as soon as you possibly can for any of this. Get it in, and then you'll find out when you get your grant as this timing goes. And that's assuming that the government's sufficient enough to handle this. If there's still money left, then those SVOs that suffered a 70% loss or greater can get more money, equal to 50% of the first application after everyone has applied. I was asked before this presentation whether or not you can get a second PPP loan, and I haven't addressed that yet, but I will, I guess. You can, in essence, get a second SVO grant, but it's after everyone's gotten what they need to get and there's still money left. So the second PPP. There's been articles out there suggesting it's possible that if you get your second draw right now, and you say, oh, I want more, can you get another draw from the second draw? So I guess 2B, 2A and 2B. In theory, it is possible, but highly unlikely, and I wouldn't say to even consider it. There is in the PPP loan for the second draw, there is an option of asking for more. That's not a second loan, that's just asking for more. And that there's a provision in there that you can do that. And there is, in theory, an idea that you could get a second PPP draw after getting your first one. But I will tell you, if you go back to the form, one of the first things that's on there right now is that disqualifies you is, did you get a second draw already? If you say yes, you're ineligible. So that's the reason I say, while people talk about it and say it's possible, just looking at the form, it's not possible. You're disqualified automatically. If you get the second draw now, you don't get a second draw based on the form. Could that change? Yes. In theory, it could, but I don't want anyone to rely on that. The SVO, on the other hand, does allow for a second draw, if you want to call it that, of it.
All right, Paul, one question real quick.
Yes.
So there is a group here in town that is a performing arts group. They do raise funds. They are a group of people, but it's not an actual venue. Would they fall under the Shutter Venue Operators Grants, or would they need to apply? They're a 501c3 organization. I know that. Okay. Or would they need to apply under the PPP loan?
Okay, so let's go back here and take a quick look. So they are, if my understanding is correct, they are a group of, let's just say they're a group of artists.
Correct.
That do live performances, but maybe they don't own the venue itself. Something like that. Okay. Yes, I believe that we could put them, we could possibly qualify them under a theatrical producer. We could possibly qualify them as an operator. I would like, if that group wants to, again, for free, I will look up the exact definition of live performing art operator after this presentation. If they want to contact me, we can see whether we can shove them in under that definition. But yes, I do believe that, I think that's possible. But as I said earlier, there's very specific definitions of each one of these, and we gotta, I would have to talk to them and get all the details to make sure. But I think we could shove them in under a shuttered venue operator grant.
Okay, thank you, Paul.
Okay. So we got to go back to what this can be used for. Again, anyone getting this, you don't have to ask for forgiveness, okay? But you do have to keep your records, and there will be extensive auditing of this. This is a grant. The government's going to look at this and make sure you did what you're supposed to do with your money. They might, let's put it that way, and you don't want to get caught. So this is what you're supposed to use the money for. You can use it for payroll, for rent, for utilities, interest on mortgage, interest on debt, which is incurred prior to February 15th. If you got new debt thereafter, you can't use this money for that. Worker protection, payment to independent contractors. I told you that's different. A lot of artists end up being independent contractors, and you can use this money to pay an independent contractor and it still be allowed. And then there's certain other very specific business expenses, which again are listed in the law itself. In real life, these things all become somewhat of an issue. as I said earlier, if you have your employees back and they're working, are you really using that money on just paying them? So again, I would say legally, let's be careful. Let's make sure we're at least allocating the money to these purposes, and then you will not have a problem with your grant. I'm not sure how many landlords are on here, but this is a big deal for me. And anyone else that has concerns of, just the public good in general, as you all know, 20 million people lost their jobs at one point in time. Many have been unable to find new jobs. Some have unemployment. Some have been unable to pay their rent. There's been a massive eviction moratorium. Landlords have been getting killed because they couldn't get PPPs. They couldn't get rent. We have the moratorium on eviction moratorium may have just been extended. But what happens once that moratorium ends? What happens? Lots of people are going to lose their residence because they're so far behind in rent that they can't possibly pay it back. This rent relief that just came in is so much better than the first round. I can't even explain it. And I'm trying to get this information out as much as I can. You'll see an article from me soon on this being on my firm blog, and I'll be trying to get it to newspapers and other groups. This time they allowed the landlords themselves to apply for the renters. So the person that has the most interest in getting paid can actually get paid. And this is vital, because if these people do not get their rent that they have owed for 5 or 6 months, they're going to lose their residence no matter what, because they're not going to have the money. The other problem with the rent relief the first time was most renters had no idea even where to go. They would just call their landlord and say, hey, what am I supposed to do? Or they call the St. Louis City and say, what am I supposed to do? Or they call St. Clair County and say, what I'm supposed to do. St. Clair actually did a pretty good job at telling people what to do the first time with their money, and they spent it. All that money is gone. There's new $25 billion allocated to emergency rental relief. Most people don't even know this. The government demanded that the jurisdictions apply for this rent relief by January 12th. St. Clair County did. It applied for it, and it's asking for $7 million in rent relief. As I said, St. Clair qualified. You had to be over 200,000 in residence in order to apply for this, and St. Clair did, and they applied. St. Clair is a little bit different than some other local areas. They delegated its request to the Illinois Department of Housing, because the Illinois Department of Housing actually did a pretty good job the first time of spending the money. St. Clair liked it, and they decided that's the way we're going to do it. So St. Clair will have an estimated $7 million available in rent relief. This new rent relief will allow the landlords specifically to apply for the money. And I'll show you, this is the language of the law. It's application for assistance by landlords and owners. It's basically saying that you can assist the renter of such dwelling to apply, or you can apply for such assistance on behalf of the renter. This is so vital, I can't say it enough. The landlord who has the most incentive to get paid and who has been destroyed recently because they couldn't do anything with people that weren't paying rent finally has some relief, and they can help their own renter and help themselves. How's this going to work? That's the tough part. Rick Stubblefield, who is the executive director of St. Clair County Intergovernmental Grants Department, which is where you would call to figure out how do I get rent relief, is actually given a presentation on this. If you are a landlord or a property owner, or you know someone who is a landlord or property owner that may be interested in how this is going to work, Rick's given a presentation on February 8th, 2021 to the Metro East Real Estate Investors Association. I would call that group and figure out when he's giving it. This is the guy that knows how they're going to handle it. He's still working it out. I've talked to him. He's still working it out. How is this going to work? What form are people going to have to fill out? How are they going to get their money? And it's my understanding there may be flat amounts that are paid, which is not exactly what a landlord would want. A landlord probably would want all the money. But for right now, it's possible that landlords, well, we know for a fact, landlords are going to be able to apply and they're going to get money. Whether they get all their money, it's a different issue. The money can be used to pay the landlord directly for past rent. And like I said, this is vital. It gets people caught up at a minimum. And hopefully they'll be able to get employment soon, especially if there's a threat of eviction again at some point. People will have incentive to get a job and have incentive to pay their rent. What's coming next? President Biden is proposing 1.9 trillion in new relief. Whether you are a Republican or Democrat doesn't really matter, because 1.9 trillion is not going to happen. Okay. There's going to be negotiations. That's not going to go through exactly as it is. So what I'm telling you right now is what is proposed, and Lord knows what's going to happen. I will tell you, on this second round, restaurants thought, the restaurant associations thought that their $100 billion restaurant act was going to be included in the second round. In the last week of negotiations, it disappeared, just went away. Same thing can happen here, but I'm telling you, this is what may occur again. And this is important for those people that say, oh, I'm going to get my second PPP draw, but I may need more. Well, guess what? If this goes through, that's your second draw. It'd be a third draw. They're proposing additional funding in this 1.9, which will include another $280 billion, approximately, for the PPP funding. There'll be a new small business grant fund if it goes through. So not just a PPP loan, a grant like the SVO grant. And there'll be another $25 billion in rent assistance, which hopefully will work even smoother than this one going now, because they'll learn from this one. So those are, the rest of it is all money for the state, money for vaccines, money for testing of the 1.9 trillion. But just so you know, you may have more options for more money to help yourself if you are in desperate need coming from this new proposal. And hopefully it will go through. So I put on here my email and my work number. My work number goes directly to my cell phone, assuming I hit the right button. So if you call after hours, you'll get my cell phone through that. So feel free to reach me. As I said earlier, I think the fundamental purpose of us as lawyers is to be there to solve problems for people. I'm not, as I told you, I'm not trying to build a practice on PPP loans. I am making some money on this. I'm charging people an hour or maybe 2 hours at most, a kind of a flat rate basis to help them with this if they need it. My intent of doing this is to ensure that people know who I am and they can come back for other things that they need in the future. But I'm also trying to solve the fundamental basis of our profession. We're here to solve problems. We're here to help. That's what lawyers are supposed to be doing, and that's what I want to do. So I will take questions if there are any.
There is one in the Dropbox, Paul. They wanted to know, back to the shuttered venue operators grants, what if you are a shuttered venue but did not have revenues in 2019?
If you had no revenue, but you were open, well, if you had no revenue, then you're not going to be able to qualify because you don't have the loss. Now, if you were open, well, again, I would ask that those people to contact me.
Okay.
If you were open, you're going to have some revenue, I would think. I'm trying to consider how you would not have revenue in 2019 of any kind. You would have some revenue and probably have none in 2020. Now, if you were not even in business in 2019, then you're stuck. You must have been in business at some point in 2019. But as I said, if you were in business for at least a month of 2019, you are still eligible. Okay. It's as I said earlier. Well, let's go back to it just so we can kind of quickly look at that. If you were not in operation on January 1 of 2019, but you were in operation at some point in 2019, then you get to look at your gross revenue for each month of operation. Each month of operation in 2019, you multiply by 6. So if you're only 1 month, which I guess is possible, you still, let's say in theory, will be available for this SVO grant.
Does a restaurant/bar who provides music at least 4 nights a week qualify as a shuttered venue operator?
Okay, so I'm just going to use Pops as my example because it's someplace I know, which is I consider it a live venue facility. I consider it an SVO, and I think we could qualify them as an SVO based on the definition of the live performance venue, because there are very few live performance venues which have live performances every single night. Okay, most do not. It is not required. It is in the law. It is not required that you have it every single night. I have to go back to the definition, but I do believe that something like Pops or other bars, which Mississippi Nights over in St. Louis, which this has been closed for a long time, but when I was a kid, that's what we went to. It was a live venue, and it was looked at as a live venue. You don't have to have it every single night, even though say 90% of your money may be from alcohol. If you're a live performance venue and you meet that qualification, legally, you're still a live performance venue. Even if you have other revenue, you're still a live performance venue. So I hate to do this, but those definitions are very specific. I would ask someone that's asking that question to contact me. We'll read it. We'll talk about the details, and we'll get an answer to that.
Okay. The next one is, how do you count a part-time employee?
So that's a great thing. In the PPP, any part-time employee is still considered an employee. Okay. And that's important because it's additional money for you on an average monthly basis. They don't have to be full-time. Under the SVO, they have specific rules as to what is a full-time and what is a part-time, and they count them as a half for a part-time. My memory of this is it was 30 hours, at least 30 hours a week was full-time for the SVO, and 10 to 30 was at half. And I can check that, but I'm pretty sure that's what it was. So the SVO it counts full-time employees, and it counts half employees. The PPP, anybody that works for you that is a W-2 is counted under the average venue, the average monthly payroll number.
Okay. This next one, I'm going to read it directly how it's written, and I'm sure maybe you'll understand it. It says, let's say I lost 30% in second quarter of 2020. Can I use the 2020 second quarter only, or 24 weeks?
Okay, so what that question is getting to is, do I qualify under the 25% loss? And my answer to that is 100% absolutely yes. The 24 weeks thing is different, okay? So let me address that. All you need is one quarter of 2020 to be 25% loss of revenue or more compared to that same quarter in 2019. So if your second quarter of 2020 was a 30% loss compared to the second quarter of 2019, 100% you have qualified for a PPP loan. You're allowed to apply, and you'll get the PPP grant. So that's the answer. The 24-week thing has to do with when you spend it. That's the 8-week to 24-week time period as to when you spend your money and how it goes to the forgiveness part of it. So it was really two questions put in one, but do I qualify? Yes. If you actually had the 30% loss, you qualified.
Okay, great. And I know Rick Stubblefield is on the presentation today when you're talking about the landlords and leasing. So Rick, if you have anything to say about the presentation you're doing, you're more than welcome to chime in real quick, say hi to Paul, and I'll let you talk about it real fast.
Okay, very quickly, because I don't know a whole heck of a lot yet. It's brand new, but we did, I know that IDA has a much better infrastructure to disperse that amount of funding than we have, right here at 19 Public Square. Paul was kind enough to give me a call earlier this week before this, and we had a great conversation. And Paul, I appreciate that, and I appreciate your time. We're working out the details. I agree with Paul that the people that have really, really been left out, or at least one of the groups that's really, really been left out in all of this, has been landlords. They've been at the mercy of tenants all the way through this. We are trying to rectify that. And that's part of the reason for the conversation on February 8th with the Metro East Realtors, is to have a discussion, get some ideas, and hear from the people that have have been most disenfranchised by this. What's the best way to do this? What makes it easier? What can we do right now to make sure when that money is ready to go and when applications are start to be accepted, you have everything ready to go. We're the first ones in the door. The other thing I'd really like to accomplish with this is a lot of areas won't spend all their money. If it's not spent by September 30th, I think it is, then it'll be reallocated. I would love to be in a position for St. Clair County to reap the benefits of those funds on the back end as well.
Yeah, and I would just like to add that Rick is in a difficult position because all of us are in a difficult position. They put this money out there in this law signed December 27th, 2020, and then everyone had to apply for money by January 12th. The fact that St. Clair County was able to get everything together and get it in, major props to you, Rick, and everyone else for getting that done. But then they're stuck with everyone saying, hey, how do I get this money? And to be honest, most of us don't know yet. It's going to be a different program because the first time around, it wasn't allowed for the landlords to apply. So Rick's in a difficult position, but I know that they're going to be able to handle this, that with the Illinois Department of Housing and other good employees will figure out a way for this to get done, to get the forms in. And once this money starts getting dispersed, it's going to help everybody.
Great. And I don't see any more questions in the chat box, Paul. So I want to thank you for your time. And Rick, thank you for working with Paul and letting us know about the program coming up. For those of you who are on the call, we have kind of a follow-up call to this next Wednesday with Scott Cruz, and he's going to be talking about the COVID-19 employee issues that are facing 2021. There are some that came out in 2020. Some of those are staying in place. Some of those have been extended. So it'd be a great time to hop on next Wednesday. If you haven't registered, please do so to learn about the new COVID employment issues for 2021 and how it's going to affect your business and employees going forward. So we really want to thank everybody for attending today. I hope you enjoyed the information that you guys had. We are truly here for you, and whatever we can do to help you get through this, we will do that. Paul's information is in the chat box. If you did not grab it, you can email us and we can get questions to Paul. If you didn't want to drop them in the chat box, but you have something you want to get to him, please send it to us and we'll get it over to him. But thank you, everybody, for your time. Paul, thank you for your time. And we will see everybody soon.
Goodbye.